Ladies and gentlemen, welcome back to Eurodollar University. We're going to talk about money velocity, printing, and a surge in the M2 money, what do we call it? Money measure in the United States, and whether that means inflation is out of control in the United States. I'm joined by Jeff Snider, the head of global research for Alhambra Partners. Jeff, you write daily, more than daily, twice a day at the Alhambra Investments blog, but you also post weekly at the Real Clear Markets site. And this week, or last week, is where we're going to right now. The title of the article was, "We Can't Depend on the M's, which only produce bad V's," November 12th, 2021. And you start out the story by talking about Simon Newcomb. Who is that?
Yeah, Simon was a 19th century economist, and an economist in a sort of a grassroots, sort of a bottom-up kind of way. He kind of fell into it. He was an accomplished academic beforehand. He was influenced by, forget who it was, never mind.
John
Anyway,
Stuart
he was
Mill?
influenced by John Stuart Mill and Say's law and things like that to take up economics, which was, to him, he took sort of an engineering perspective because that was his background. And he thought, well, John Stuart Mill had kicked around this idea that we could kind of create a formula for how an economy works. And he came up with what he called the equation of societary circulation, which then Irving Fischer borrowed and became the equation of exchange that many people might be familiar with today. But essentially, if we have money, we have the circulation of money. That can tell us about output or income as well as the changes in prices. Because as we know, inflation is always and everywhere a monetary phenomenon. So money supply versus velocity, money supply combined with velocity should give us the inflation plus economy.
So if I remember correctly, that's M times V equals P times Q. Is that right?
Yeah, and there's all different modern versions of it. So instead of P, Irving Fischer had T, which included financial transactions. I think the more modern versions are Y, which is national income, rather than essentially, everything possible that Fischer had it, as Simon Newcomb was talking about. Because let's face it, if you're printing money, as people talk about too, some of it ends up in asset prices.
Okay, so V is what we're going to be focused on, and M. And so the idea was Newcomb concerned because he was writing, when was he writing? The end of the 19th century? And it was very interesting that was in the 19th century where we started observing these remarkable economic events, which we now call depressions, where all of a sudden people were put out of work for nothing that happened to them, but somewhere far away, some sort of destruction of money. Is that right, Jeff? Is that what motivated him, is to try to explain these remarkable economic collapses and then resurgences?
I don't know if that's specifically what motivated him, but it certainly gave, you can read, if you read anything he wrote, and it certainly gave his quest a sense of urgency, right? Because he was looking for the answers anyway. And then, as you pointed out, Emil, exactly right, there were these mass widespread depressions that, back then, we kind of take it for granted nowadays, but back then nobody had really any idea what was going on. The study of economics was very new. Any serious study of economics was very new. And as these depressions were themselves even newer than the study of economics, it was sort of hard to put all these things together. And so there was a very, very strong emphasis on seeing how we can maybe come up with a way to really figure out how the structure or the machinery of exchange, as Henry George called it, how does this all fit together and how does it actually work? And what they realized back then was that, as Milton Friedman realized when he formulated his hypothesis, was that, look, money and depression, those two things at the very least go together. And as we've known throughout history, going back to Copernicus and Isaac Newton, that when you cheapen money, you get inflation. So money, inflation, also money, depression, deflation, all of these things are tied together. So if we can figure out the money side, which includes circulation and velocity, that should give us at least a very good understanding of what's going on in the real economy and therefore its actual potential.
Circulation velocity, or as Newcomb called it, rapidity. That's the key point, because it's not just about having enough money. It's whether or not it's moving. And you tell us, what if it's stuck somewhere? What if it is being hoarded, as in a depression? because money all of a sudden is very valuable. It's not being used as a tool to conduct exchange, but it has become something so valuable that you rather hoard it than conduct exchange, and the economy slows down.
And the other part of that, right, is, as Newt Wixel said, interest rates. Interest rates are supposed to, in theory, take control of that redistribution. They're supposed to influence redistribution and velocity, right? If interest rates go up high enough, that's supposed to induce those who have hoarded money to then de-hoard money and get it back into the economy if there's that much rate of return. But as we also see, especially in the modern age, going back to the Great Depression, and again in 2008, sometimes interest rates don't work in that way. In fact, we see instances, as we've talked about before, last March, for example, or September of 2019 in the repo market. We see instances where interest rates actually create a situation of backwards elasticity. Getting a little bit ahead of ourselves here, we're talking about money supply and velocity and how they relate to real economic conditions, but it doesn't always work that well in practice versus theory.
Well, that's what the question that you ask. If you could make the equation on the money side balance so elegantly, say goodbye to depressions or runaway inflation. So why doesn't the Fed or any central bank do this? And then you gave a very good, very funny answer here. Do you remember what it is, basically? Okay. The problem with the equation of exchange is that it really isn't an equation at all. There is no mathematical proof which proves each of its two sides as an equality. The problem with velocity is how there is simply no way to directly measure it. And the problem with the whole idea is that it presumes the world as a static place where the variables are the same or like enough forever after.
Yeah, it assumes that what's M today will be M tomorrow. It assumes that what motivates V today will be the same thing that motivates V tomorrow. And those are arrogant assumptions that are ahistorical, because throughout history is history for one reason, because humanity doesn't stand still, especially in the modern industrial age where we're inventing and innovating and doing all sorts of great things that just simply change the way we do such things. And that's not necessarily a bad thing. It just means that if we're counting on a static society to create, or a static assumption to create these sort of mathematical models of how we think things work in the theoretical level, they're not going to have much use in practical purposes because they don't have much use practically. They're not a realistic representation of how things actually go.
Because in different eras, different moments, the money requirement is different for whatever reason, or the velocity. You don't need as much money because of velocity or whatever the reason. There's just eras are different, people are different, generations are different, technological advancements, globalization, deglobalization, wars, various things happen throughout time. Maybe in some very short time period, yes. But over long time spans, this should be fluctuating wildly. But that was not the assumption. It was assumed that it's some sort of single equation constant, M or V, or which one was the constant? V was the constant, right? And M is what could be fluctuated up and down by central bankers.
Right, and that would be the fatal conceit, right? If you thought M was relatively constant because it seemed to be relatively constant, you could make an intuitive case for it to be constant. Then all you would have to do is raise or lower V as desired, and you get the P times Q side of things to work out exactly the way you wanted them to. Unfortunately, that wasn't the case with any of the M's, because almost as soon as the M's were derived in the early 1960s, by the late 1960s, it had already been underwritten and undertaken. M1 had basically been made obsolete by the Eurodollar system before anybody even really started using M1 in any practical fashion. So already M1's been erased, and it ran into the same sort of problem as we're going to see with M2, where in the early 1970s, its velocity seemed to change.
Tell us about that. M1. Why did M1 seem like the velocity was being backed into as increasing rapidly? Is that right? Because the economy was expanding.
Yeah.
Velocity was surging. Go on.
Yeah, no, it's just we don't actually observe velocity, right? It's sort of a derived variable. Like we calculate P times Q and then divide M gives us our V. It's sort of the remainder in the equation, right? We solve for V. It's not like we can independently verify it in any empirical fashion. So what happens is the nominal economy, obviously in the Great Inflation, was surging, but the level of M1 was growing, but not growing by the same amount. Therefore, again, because velocity is a remainder variable here, velocity appeared to be rising and rising rapidly, well outside any kind of statistical range or any confidence range, which suggested something was going on here. In reality, it wasn't that velocity was rising, it was the calculation showing that M1 was no longer a relevant variable to the actual economy. And the economists and central bankers had the same problem from the other side, which was forecasting M1 money demand, which always seemed to be coming up short. And how we reconcile all of these inconsistencies is by realizing that the nominal economy was growing and M1 money supply was not growing as fast because the real economy participants, the banking system, were inventing new forms of money that the real economy was using in addition to M1. So there were broader forms of money that M1 didn't capture that actually explained how velocity didn't really fall off, or velocity didn't really rise, and money demand didn't really fall off. We were just calculating it wrong because the M had changed.
We didn't know all the M's. We didn't know all the M's, but we thought we only had M1 to worry about. If we had all the M's, then maybe nothing really would have changed. Okay. Thankfully, they learned their mistake and they updated with a new thing called M2. And that story that you
Problem
just
solved.
yes,
Right?
that didn't
Forever
happen
after.
again with Mr. Greenspan, where we saw all of a sudden M2 suddenly rise in 1990, just as the Latin American debt crisis was being resolved with the Brady bonds and the Soviet Union was collapsing, globalization was taking off, and something Solomon Brothers was doing. M2 velocity surged. Is it the same
Just like
problem?
M1 had 20 years before. All of a sudden, and remember the other part of this, which was sort of our central point here, is that also in the late 1980s, as M2 velocity started to increase unexpectedly, we had the S&L crisis. Now, why does that matter? Because what we're really talking about with M1 and M2 is sort of domestic depository forms of money, things like deposit balances, your checking accounts, whatnot. And as the S&L crisis developed, especially in 1988 and 1989 going forward, what that represented was a fundamental change in banking. That was sort of the last hurrah of the depository way of doing banking. Because as in addition, beforehand, before the S&L crisis, we had this rapid rise in what were used to be called commercial banking. There used to be that very distinction because it was a very bright distinction in the way these banks behaved, as well as the monetary forms they used to fund their activities. The commercial bank, which is more of a securities dealer firms, the Goldman Sachs and Morgan Stanleys of the world, they funded their operations using wholesale interbank money rather than strictly depository money that might be captured at M2. So as the S&L crisis developed and these depository types of banks started to fall off at the margins, it wasn't a surprise that M2 money supply started to decline, which meant that because the economy didn't suffer a Great Depression in the early 1990s, that M2 velocity seemed to be rising in a way that didn't make sense to Alan Greenspan or economists. When in reality, what was happening was the same thing that happened to M1. M2 velocity wasn't rising. There were still other forms of money the real economy was using that banks had dreamt up with, these wholesale forms that as these commercial banking and as the commercial banking way of doing business ascended in the early 1990s, obviously those forms of money they used took over the marginal influence over the real economy. So M2 velocity didn't actually rise. It was, again, this transformation which showed that M2 was no longer sufficient to capture what was really going on.
You've now transitioned to another article. The audience can find it on the Alhambra Investments website. Is M2 the money behind inflation? If not, what is or isn't? That was posted on the 15th of November. Jeff, you note that one organization was trying to identify, define, measure, map money, credit, collateral as best they could, and that was Morgan Guaranty. And you have some estimates here, this chart that shows what M1 was, what M2, M3, and that those estimates were already higher. You know, the Morgan Guaranty measures of this offshore Eurodollar system, They were showing what was not being captured in the official statistics. And you tell us that they gave up because they knew they were not capturing everything. This was like a light estimate, and it was already way ahead of where M3 was.
Right. And that was the 1980s, right? We're talking about the late 1980s. That was the chart that I showed in that article, was actually from a speech I gave back in June, I think it was. And it was really talking about the evolution of money and how M2 has been misleading for many, many decades before we even get to the global financial crisis. And the reason is because of this other stuff outside of M2, these other monetary forms, that even though the Federal Reserve didn't sanction or didn't include it in a monetary aggregate, the real economy was using it. And when we say the real economy, we are not just talking about the United States. We're obviously talking about the rest of the global economy too, because this global dollar, this offshore dollar system, was the reserve currency for the entire global economy. So as Morgan Guaranty had done for decades before 1988, they tried to keep up track, or at least compile some kind of data on this euro currency market, and even just some of its most primitive forms. What they found out was that by 1980, or the early 1980s, this other euro currency market, which is all Eurodollars and the other side of Eurodollar transactions, was about as big as M2 and M3 had been in the early 1980s. Fast forward to 1988, and the euro currency market was a third larger than the entire depository domestic money supply, M2 or M3. So we have vastly more sums of euro currency, whatever that is, and outside the United States by the late 1980s, that helps us explain this velocity puzzle, which really isn't a velocity puzzle. It's an evolving M. M1 was outdated a long time before then. M2 came to be outdated long before the 1990s. It just didn't show up as easily. And then you go forward in the 1990s, which was an era where the Federal Reserve threw up its hands and said, we can't even keep track of money ourselves, so we're not even going to bother. And that's really the point here, is that M2 was obsoleted long before the 1990s. This change in velocity in the early 90s was just simply the last sign that you couldn't depend on M2 for any realistic representation of what's going on in the actual money supply, because money had evolved so drastically.
Let's talk about modern day. The 2020 crisis, and thereafter we saw a surge in M2. And that's often pointed to as a reason that there's a lot of money in the system, and therefore inflation, of course. What is your interpretation of this surge in M2? What can we take away from it?
Well, I think we talked about M2 once before we got to the CPIs this year, when we said, look, I think it was January, maybe February, or earlier this year, we looked at M2 and said, M2 rose dramatically. I mean, it was almost a 30% increase in March, April, and May, I think up to June 2020. And here we were in early 2021, and we hadn't seen any sign of inflation yet. So where's all the money? And then, of course, the CPI started to go crazy, and that's where everybody said, aha, there's the inflation. The money printing happened. Maybe it took a little bit longer. We don't really know why. Maybe it took a little bit longer. But now we're connecting these high CPIs with that high rate of growth in M2. And there's the money printing. There's the inflation. Therefore, we are going into the 1970s again. And our point here is that M2 is misleading, even if the CPIs are high in 2021. That has nothing to do with M2, because M2 doesn't really tell you very much about the real economy. It certainly doesn't tell you anything about the offshore shadow money world, which in any number of real-time signals, as we just went over in the first segment of this episode, are all screaming tight money and deflation. And we can go back to 2008, which I think is a perfect preceding example, when in the latter stages of 2007 and early 2008, leading up to Bear Stearns, M2 money supply growth surged. The global financial crisis of 2008, you saw money supply, according to M2, dramatically rise, leading up to the failure of Bear Stearns, and what was up to that point, one of the most poignant and worst examples of a monetary insufficiency and monetary tightness before the Great Depression. And then it happened again, starting in the week after Lehman Brothers and AIG and Wachovia in September 2008, M2 money supply surged even more in an unusual fashion. I think it was something like 7% in about 4 months, 3 months, whatever it was. is a huge surge of M2 money supply during the worst financial crisis since the Great Depression. Not just the worst financial crisis, the worst part of the worst financial crisis, the worst monetary crisis since the Great Depression. M2 was through the roof. So already you should know, as we had known in the early 1990s, that M2 doesn't really tell you anything meaningful about actual monetary conditions in the real economy because it's been outdated for decades. It's too narrow in its definition.
We're seeing a surge in one narrow area of money. What about the bigger picture? Well, we look at the Treasury International Capital Report, bond yields, Eurodollar futures, all manner of other things, and that's signaling the things we can't see in the shadows.
No, and I think, we wish there was an M4 or an M5 or M whatever, an L, as they used to try to look to determine. But having done this for a lot of years, I can tell you that even if we could come up with a modern version of an M aggregate that was reflective and representative of the real monetary condition, it would be outdated by tomorrow. In one sense, there's really no point in doing these M's because the system evolves over time, and sometimes it evolves very quickly. And I wonder how can you stick the entire collateral securities lending system inside of an M anyway? It's really one of those things where you step back and say, it was a good idea. The equation of exchange was a good idea. Maybe there's some noble purpose in trying to work through these economic processes in your head, to do thought experiments and think about them that way, but they're just it's entirely impractical.
That's what many of the comments are about this show. Good idea, but just impractical. And ladies and gentlemen, you can leave those kind of comments in hate mail, death threats, ransom notes in the YouTube section or on Apple Podcast reviews or on Twitter. You can find Jeff at JeffSnider_AIP and me at Emil Kalinowski. Jeff, I had a good time, and I'll talk to you next week.
All right. Take care, Emil.